will share my screen. And pull up my chat window and welcome everyone to Chapter 4 in our book. So, as always, participate as much as you possibly can. This class has been excellent with that. We're going to start the day with a whole bunch of polls. So what I'd like to make sure everyone does, can you pull out your Inkling and your self-test number 1, get the answers you've already prepared up. Give me a green check mark when you have your answers ready to go so that I know most of you are there, because I'm not going to give you a lot of time for the polls because I'm assuming you have all practiced. If you haven't practiced, try your best on them anyway. You might know the answer right away, but we're going to do these fairly quickly. So we're doing that first, self-test review, and then we're going to jump into our textbook today. So here we go. Oh, got to pull this over to the side. And we're going to start with the first one. And that is Jeff. So Jeff received a T4. We have his information about his T4. He also had tips and he had an inheritance. And they're going to ask, what are you going to put for his total income? And I'm going to open a poll, which you should now see. And I'd like everyone to lock in the answer that you got for that one. And once we have the answers from everyone, we'll discuss it. The idea for these self-tests being just to review the basic concepts in the first 3 chapters of the book for self-test 1. Okay, half of you are done, and I am waiting for the rest. You have 20 seconds to get your answer locked in, so if you're not sure, try your best. Make sure you hit that submit button. Good, still waiting for a few people. We have 5 seconds, you can get an answer, and if you hit it really, really quickly. Okay, let's see how we did. I think we did pretty well on the first one. If you're not sure, let's talk about it very quickly. What do we include in income? Well, everything covered by the Income Tax Act, which is income from office or employment. So we know that the T4 will be there, and the tips, because that counts as other income. One thing that is not included is the inheritance. Inheritance is not reportable on a tax return. It is not taxable income. So you should now see the results, and you can see pretty much everyone got that one exactly right. We're going to take this T4 box 14. We're going to add the tips. When you add those up, you get to your total income. Great. Good job for the first one. Let's move on to Sarah. So this one you will need to do very quickly if you haven't done it yet. Hopefully you've already tried it. We want to know what her total required CPP contribution is. That is her base contribution plus her enhanced amount. Again, only 1 minute. So let's, where did it go? Open this one and see what we get. Okay. There are a bunch of different answers there. Only one of them in this case is the right answer. This is what everybody wants. First thing on a Monday morning is a pop quiz. But again, these have been in your book and you knew we were doing this today, so it should not be a surprise. All right, so I've got a few more people to answer, but 5 seconds left. Get that answer locked in, hit the submit button. And again, I would say overall, pretty good. Okay, I'm going to give you the correct answer was E. So if you said E, you did very well. It is $1,716.75. How do we get that answer? We're going to take the insurable pensionable amount, which is $35,000. In this case, we don't need to know that that's the insurable amount. We care about pensionable because we're talking about CPP. Subtract the base amount. The base amount was $3,500, so you can take $35,000, subtract $3,500, and then we're going to multiply by the CPP amount for 2021, which was 5.45%. If you didn't get that one right, I do recommend you go back to the textbook, and you can go back to the recording of our class where we did several practice questions. So if you haven't had enough practice in the textbook and you would like more, go back and redo those ones. Be careful, make sure you are taking off the base amount, and you're only taking off the base amount. And don't get mixed up between total required contribution and basic required contribution, because the basic you'd be missing the enhanced, and we actually need both. Okay, who is next? So Jamie, question 3, and I have to find which one is my Jamie poll. Here we go. And we're going to do another one. So this is a yes or no answer. If you don't know the answer, guess, you've got a 50-50 shot. But we have shares in a U.S. company. We've already done the conversion for you. It cost Canadian $105,000, and then in 2021, it's currently worth $85,000. Does he need to, or should he file a T1135? So should he file a T1135, yes or no? Okay, 20 seconds left. Got 4 more people I'm waiting for. Let's see if we can get everyone participating in this. And I'm seeing excellent results so far, so that's wonderful. Hit that submit button, and let's see what we get. So if you picked yes, and almost everyone did, you are correct. Remember, T1135, when we're talking about assets that have values that fluctuate, things that change, like shares, we don't need to know what they're worth today because that doesn't mean anything. Tomorrow they could be worth more again. We need to know what they cost. So the cost value is the only number we need to look at, and that is 105,000 Canadian, which is over 100,000. So if that's the only foreign asset he has, he does need to report it. Okay. Now, for Jamie, can you tell me in the window, will we use Part A or Part B? So in chat, are we going to use Part A or Part B in order to report the T1135? So we have an asset, we need to do a T1135, but what type are we going to do? Okay, most people are saying A. I agree, do simplified. If you can do simplified, we're going to do simplified. Excellent, and in this case, all we have to do is pick off the list what he has, which is shares, and then what country, and we're going to say USA. What will we put for income? Because we also then have to say income from the shares. So given this case, lots of people are saying 0, and I agree with you. You are all correct. It is 0 because there is no current income that we know of. If there was going to be income, what type of income would Jamie have from this asset? What is the only type of income this asset can generate? Not capital gains, because that's not in the income for a T1135, keeping it separate from the date of a tax return. What goes on the income line only? This is stuff that you get while you own the asset. What can he receive while he owns the asset? Dividends. Dividends is the only source of income that Jamie would receive from this asset. So if Jamie did have dividends, that's what would go on the income line. And then, yes, then it would go on the tax return as income. Excellent. And now, anticipating the next question, we also have to report gain or loss. What number will we write on gain or loss on the T1135? Good, and I've got really good answers in the chat window. If you put 0, you are correct. Because Jamie has not yet sold them, there is no gain or loss. The gain or loss only happens when you actually dispose of the shares. So even though they've gone down in value, we don't need to report the change in value anywhere because it's not real until a transaction happens, until you actually sell. And then Leon, excellent question. If you sell, will the income be capital gains? Yes. So if you sell, if Jamie sold some of the shares, then Jamie would have to report either a gain or loss on the gain or loss line, and then on the tax return, that would be a type of income called capital gains. So the dividends would stay on the income line if there were any, and then any transactions from a sale would be reported as a gain or loss on capital gains. Good. And if you've got that straight, you have this well under control, and you can go on with your studying. If this is not very comfortable for you, go back to chapter 2, go through that recording that we went through and see if you can sort it out. We did a practice question in class that will help you. Excellent. Now we're going to find the poll for Gary. Sorry, my window is giving me a bit of a hiccup, so I'm just going to reload the poll. Here we go, Gary. All right. So Gary's a kindergarten teacher, purchased board games to be used in class. For the purpose of the eligible educator school supply tax credit, how is this claimed? A, consumable goods that are eligible supply expenses. B, prescribed durable goods that are eligible supply expenses. Or C, cannot be claimed. Okay, got a few more people to hit that submit button when you think you know the answer. And again, normally I would give you more time to answer these polls, except you should already have done them, so you should have an answer ready to go. All right, let's see how we did. Again, pretty much everyone got this, so I'm really excited because that means I'm doing my job correctly. They are not consumable because the last I heard, it's not a good idea to eat board games. Now, if it is a kindergarten class and you have very young kids and the board games have small pieces, they might eat them accidentally, but that's not how this works. So if they're going to be eligible, it would be prescribed durable goods or not. And to find out if they're prescribed durable goods, we have to look at the list. And the list specifically says games and puzzles are eligible, so he can claim them. So Gary is a kindergarten teacher. That's important because if Gary was not a kindergarten teacher, the answer would be no. And it is a prescribed durable good, so you can tick B. Now, in order to claim them, what does Gary need to have as proof? So if the CRA asks for proof, what will Gary have to give them? I'm looking for 2 answers. Let's see if we can get both of them. A letter from the education institution, so from the school, saying that they had to pay things out of pocket, and receipts. So both of those things. So before you put it on the return, ask Gary, can you get those things? And Karina, you do not need a T2200, although you are right that some employment expenses are reported on a T2200, but these you specifically don't need a T2200 for. One of the reasons why they came up with this was supposedly to make it easier for teachers to claim them. Good. If Gary spent $1,000 on the board games, how much will Gary get if he claims all of those receipts? Okay, so I've got one answer, 250, very good, 25% as a refundable credit. Good. What if Gary bought a lot of board games? What if Gary bought $5,000 worth of board games? What option might Gary have that we would not do in this course, but you need to know to tell him? Okay, cannot carry them forward. They can only be claimed in the year in which they are purchased. So now we have another option, and in this case, it's going to go find another tax preparer who knows how to claim employment expenses and see if they can get more for you, because they might have an option. So if you know you're going to waste a lot of receipts, go get an expert in a more complicated part of the tax return. But probably for his board games, he's not going to spend $1,000 in a year, in which case, as long as we can put it on the return, go ahead and put it on the return, because that $250 refundable credit is going to be the best possible option for him. Excellent, good. And then would they be current or capital expenses? Well, the nice thing is for this purpose, for employment expenses, we don't need to worry about that. If you get into employment expenses, it gets trickier. And that's going to be outside the scope of this course. But if you have more questions about that specifically, ask me after class today. And I'm happy to give a little bit of extra information about how that would work. Okay. And then question 5, Carol is a search and rescue volunteer. So again, I'm going to find my correct poll, and I'm going to open it. So Carol received a T4 slip reporting 1,000 in box 87 and 500 in box 14. Her certificate states she volunteered 250 hours in the year. How does she treat this income on her tax return? And only one of these answers is possible. So I want you to give me the possible answer. All right, and we're getting more of a mix on this one. So this is going to be a really good opportunity for me to clarify a few things, which is good. Okay, just getting the results. It shows me the results while you're entering them. I don't know who's entering what, but I can see that the answers are going in, and then when it's calculating them, they take all the results away. So here we go. So you can see we got a real mix of answers here. We had some people say A, some people say B, some people say C. Let's talk about the case itself and then why some of these were not correct. So remember, you have box 87, it is exempt income. It is income that is not included in box 14. So if you have income that is not included in box 14, it is not going on the tax return and you are not paying tax on it. The next question we have when we have a volunteer, firefighter, or search and rescue person, in this case is search and rescue. She's a volunteer search and rescue person. How many hours did you do? 250. Now we have a choice. We can elect to claim the search and rescue volunteer amount. But if we do that, what happens to the income that used to be tax-free? So we want to give a $3,000 credit, which would be great, but what happens to the income? Marisa, excellent. It has to be included. Now it's taxable. It wasn't before, so it's not showing up on the return. Now it's taxable. So all three options we had on our question said we're going to claim the rescue amount. So if we're going to claim the search and rescue amount, we have no choice. We must include the income. So now that we know that, how much income do we need to put on the return? Can I get a volunteer to tell me? Now that we've talked about it, she already had 500 in box 14. We're going to add the exempt income, and in this case it was 1,000, so now we have 1,500. And that's why B is the correct answer, because you can't have both the exempt income, so both have income not showing up on the return, and the credit. You don't have that option. What choice does she have if she does not want to report the $1,000 income? If she chooses not to put the $1,000 as income, what option does she have? Good. So we've got Brittany, we've got Helene, we've got Leon. Well, Leon, that one's not correct because if you put it on line 1040, you're also claiming it. But what she can choose to do is don't claim the credit. So if she doesn't want to claim the income, she can't get the credit. If she claims the credit, the income becomes taxable. Okay. I know where this gets the most confusing is if she doesn't have income, can you still claim the credit? If she had never had a box 87, then A would have been correct. But because she had a box 87, as soon as we put the credit on, we have to go look to see, is there exempt income? If there's exempt income, we have to add it on to line 10100. It goes back into taxable income, employment income. Okay? So if you're not comfortable with this, go back and practice some more. There are a few, I think one of the chapter review problems we had Enrico Cruz, who was a firefighter. You get to practice with him. Helene, does the software do this automatically? It does, and it also picks the best option for you. But the problem with the software, and we'll talk about this when we get to it, as soon as you have a box 87, it assumes that they definitely did 200 plus hours. And so the software will give the credit to anyone that they know is a firefighter or search or rescue volunteer automatically. So if they have a box 87, they know that they are that. And that might not be true. So even though the software will do things automatically for you, you have to think about the return and know what you're expecting to see on it and check to make sure it's doing it right. Because this is one of those places where sometimes the computer will put something in that you shouldn't be giving your client. We'll cover that when we get to the software. And Leon, do you put it online? You put it on only on line 10100. So it's just taxable income from employment. That's all it is. Okay. Let me double check. I'm going to pull up a tax return here, and we're going to take a look at it together. So these are excellent questions and the reason why we do review. So what I would be doing is if I had a box 87, I'd be entering it there to let them know that there's exempt income. But if we are adding the income in, we are adding it in on line 10100 because if we put it on a reporting line, it doesn't make it into the taxable income figure, which is the problem. Okay, excellent question. All right, one more. Oh, that was it. We're done the self-test. Congratulations. Sorry, my polls got flipped around to the order that they were in, so I will close the polling. And that should be it for polling today. Good. I have one more question before we jump into the actual chapter for today. And that is just to make sure that everyone at this point has completed the learner's guide and the training that we have in ULearn. So just to show you what that would look like, I did it myself over the weekend so that I could show you how to double check that you have done it. This is important because you're not going to be able to access your assignment until you have finished this. Now, if you have done it and your assignment shows up, please don't open your assignment because you don't get to do it twice. So once you open the assignment, you have to finish the assignment, and it is a case that you have to finish by hand. So it's going to be really difficult to finish it when we haven't covered the chapters yet. So don't run the assignment if you do see an assignment, but I do want to make sure everyone has finished the learner's guide and the training. So how do you know if you have done the training? You're going to go to your transcript. So from ULearn, the home page, you're going to go to where it says My Transcript and click on the green In Progress. You can get to this from Learning View Your Transcript as well. I just find this easier for me. Now, if you have training waiting for you to do, it's going to show up here. So there is other training for this particular instructor login, and anything waiting to be done is going to show up here. If you have finished training, you can go to the filter where it says active, and you're going to drop down to where it says completed. So if you're looking for something that's disappeared, that's where you're going to go. So I'm going to go to the completed section. Just to show you that again, if I want all the active training is the first training that comes up. If you're not seeing what you're looking for there and you want to go back and try it again or run it again or take a look at something, you can go to completed. So we'll go to the drop-down box, click on the arrow, and I'm going to say completed. And you can see here we have Tax Academy Level 1 training. So from here, if I choose Open Curriculum, it's going to take me to where the training was, which looks like this. We have How to Succeed in a Virtual Classroom, and we have the Learner's Guide. And you can see I can relaunch these. So if there was something that was covered in there that you want access to after the fact and you want to get back to it, you can go take a look at it again. But I know mine are done because I have a green check mark on the side. So I'm going to ask everyone in the class before the end of today, before next class, make sure you've gone into your ULearn training and make sure you have green check marks on both of those. If you don't have green check marks on both of those and you're not sure what happened, send me a screenshot and I see if I can help you out from there. So email me a screenshot. If you can't find it, make sure you're looking in the completed section. Okay, but I do want to make sure everyone has this done. So I will be asking next class for confirmation that you've completed the training. Okay, good. We've done the self-test. We've done the administrative homework. Let's get into actual class for today. So what are we going to cover today? We're going to talk about a lot of the sections on credits. So we're going to talk about what a credit is again. Can I get a reminder from anyone? What is a non-refundable credit? So if I say non-refundable credit, what are we talking about? What numbers are they? It reduces the tax you have to pay. Good. So it comes off after you have calculated your federal tax. Brittany, excellent. It will bring your tax owing down to zero, but not past zero. Very good. What is the value of most of our non-refundable credits? So deductions come off at the tax bracket, but non-refundable credits come off at 15%. Good. So we all know what we're looking for. We're going to do a bunch more of those today. We're going to do personal amounts, kind of, sort of. I say kind of, sort of, because we're really only going to do one of them today. We'll get into more of it again as we make the tax return complicated. So as we add family members, as we add dependents, as we add medical conditions, we start to get more complicated. So we're going to come back to this section and we're going to keep building on what we know. But we're going to start with what we call a basic return today, which is a single person with no dependents. So we're going to do those credits today. We're going to talk about the home buyer amount. And then we're going to talk about one refundable tax credit, one new refundable tax credit, which is for Manitoba, very important, which is Climate Action Incentive. And then GST and Canada Child Benefit. And then we're done for today. And we should have time to do our review problems as well. Okay. I'm going to skip through the self-tests because we did them together. Okay. Some examples of non-refundable tax credits. You already know CPP. However, which portion of the CPP is non-refundable? So when I say CPP, non-refundable credit, what portion am I talking about? because we split it into two parts. It is an employee deduction, so that is correct, but when we split into two parts, what do we call the two parts? We have enhanced and we have basic. Which one is the credit? Basic is the credit. Very good. So the basic amount is the CPP non-refundable credit, not to be confused by the enhanced amount, which is a deduction and therefore starts with a 2. Okay, we've learned EI premiums, which are completely a non-refundable credit up to the maximum. We've learned the volunteer firefighter amount and the search and rescue volunteer amount. That's a $3,000 credit. You get it or you don't get it. And we've talked about the CAN employment amount. So the only one we're really going to have to add to today is the very first of our personal credits. Okay, provincial credits we're going to talk about next week as well, because we're going to be looking at provincial forms starting in Chapter 5. Okay, and as we've already said, they are reduced. They used to reduce your taxes down to 0. Anything left over is lost. We can't use it. Okay, with a few exceptions. So for those who know your tax return, there are a few small exceptions where we have choices to carry things forward, but most non-refundable tax credits are just used up. The thing I haven't mentioned, and I will mention today because it's important, non-refundable credits have to be used in the order in which they appear on the form. So we start at the top of the form for non-refundable credits, Part B, Step 5, and we apply all of the first credit, and then we apply all of the next credit, and then we apply all of the next credit until we get to the end of our credit section. And it seems like that wouldn't matter, because if we don't need them, then they just get wasted anyway. Okay, so we would say, why does this matter? The reason is because sometimes we can decide out of a couple, so out of 2 people who are either common law or married, we might be able to decide who is going to claim the credit. So if you have a married couple and you have 2 people who could claim a credit, or sometimes it's not married people. We're going to learn about that today. Sometimes it's just 2 people who bought a thing. You can decide how to share some credits. And then it will matter, because you wouldn't want to give the credit to someone who can't use it if the other person could. So this is the part where we get to make decisions on a tax return. This is the part that makes tax returns fun. To do that, you have to know which credits come first, because when you get to a credit where you can make a decision, you need to be looking at both people's tax returns to see how many credits before that do they have and how many credits do they need. Does that make sense? Are there any questions about that? I'll point out these scenarios whenever you see. And Leon, do you need to fill in all the credits even if you've reached 0? No, if you don't want to claim a tax credit, you don't have to claim a tax credit. Now, that being said, for this course, I'm going to recommend putting them in because it's good practice to put them in, and because we're probably not going to give you a lot of scenarios where we don't need them. So you do need to think about the credits and you do need to put them in, but then when you make a decision, if it's not going to make a difference on the return, then you're going to get the right answer whether you put it in or you don't put it in. The tricky bit is making sure that you really know that. So in order to know that, you kind of have to try it with the credit in and see what happens, and take the credit out and see if it does the same thing. Okay, so I recommend filling in all the credits you have available to you. And then before you finalize the return, ask yourself, do I have any options here? Do I have a credit that I can save? Can I put it on a different tax year? Is that an option? Often it's not, but sometimes it is. Is there someone I can split this credit with, or share this credit with, or give this credit to? And can they use it? Because if they can use it and I can't, I want to make that decision. Okay, let's talk about personal amounts. So personal amounts are the amounts that are on the very first part of Step 5, Part B of the tax return. They are all non-refundable credits, so we're looking in the same part of the tax return. They all start with a 3. Okay, we call them personal amounts because they are related to people in your family. Okay, so we lump those ones together, and then we have a second section where we have all of the other credits. Most of these we're not going to do today. So we will do the basic. We'll talk about the age amount when we get to the chapter on seniors. We'll talk about the spouse or common law partner and eligible dependent amounts when we get to the chapter on families. And we'll talk about caregiver amounts when we get to the chapter on medical expenses. So I will tell you a rule for this class is if I haven't taught it to you yet, I don't expect you to be filling that line in on an assignment or a review problem. So if I haven't taught it to you, we won't be using it yet, but you will be coming back to it. Okay. Where do we find these? Well, if I show you my tax return here, I'm looking for my 3000 line numbers, and I'm looking for my Part B, and you can see the personal amounts are at the top. We have line 74 through to line 80. We add them together in one group, so that becomes our personal amounts, and then that gets carried down to the next page. Then I add the other non-refundable credits that I'm going to use, which in this case, you know about the basic CPP, EI premiums, firefighters amount, search and rescue amount, and Canada employment amount. Those are the ones you've learned so far. So we do our credits in 2 chunks, but at the end of the day, they all get added together. And once they get added together, we go down to the bottom here and we take 15% of them. And we use this to reduce the federal tax that we have calculated. And again, we're going to practice this in great detail in Chapter 5. Okay, so let's talk more about the basic personal amount. The basic personal amount is designed to make it so that a certain portion of everyone's income is fundamentally not taxed. So we all get a chunk of money that we don't pay tax on. If your income is below that amount, your non-refundable credits will be more than your federal tax owing, and the net result is that you will not be paying tax. Okay? It just got more complicated. So basic personal amount, if you go back to older returns, was one number for everyone. So everyone had a set number, and that number changes every year with inflation, but it was just one line. In very, very recent years, there's a new rule which says if you're in a really high income bracket, you have to pay a little more tax even on the first portion of money that you have. So you know if you're on the very, very high tax bracket, you have to pay tax on the top part of your income. You have to pay 33%. Lower parts of the income, you have to pay higher tax amounts. They're also saying right up front, you get less exempt income than everybody else does because you don't need it because you have a lot of money. So that has made our returns a little more complicated. What it means is if you're in the very, very top tax bracket, your personal credit is $12,421 for the tax year 2021. Okay, so if you're in the top tax bracket, if your income is over $216,511, then you only get $12,421. If you're in the bottom 3 tax brackets, you get the full personal amount, which is $13,808. Okay, so far so good. That's really easy to do. The tricky one is anyone in the 4th tax bracket. If you are in between the highest and the second highest tax bracket, then what we start to do is we start to reduce your basic personal amount little by little. And to do that, we need to do a calculation. Okay. Are there any questions before I get to that? Because I know it looks really confusing. I find it helpful to think, bottom 3 tax brackets, I get the full credit. Top tax bracket, I get the reduced credit. I only have to worry about the in-between if I'm in that 4th tax bracket. Okay. The fun bit on tax returns, as we've already learned, is they're only 8 pages long, except that sometimes we need calculations. And so when we need a calculation, we have a schedule or we have a worksheet. So those are the 2 places we're going to go to do calculations. And in this case, the line will tell you if you are not in the top tax bracket or the bottom 3 tax brackets, we need a calculation. It tells you where to go to find it. So that way you don't have to memorize this form, that form goes where, just take a look at it. Yeah, Brittany, it's 8 pages except for all the lines with their own 3-page forms or 4-page forms, or you're going to see the Manitoba ones are quite long. So some of them are 5-page forms. Printing paper returns is super fun. In an office, we do 3 copies of every paper return, and we have to add all the receipts to it too. So we still kill a lot of trees in tax. All right, so let's find the worksheet. How do we find the worksheet? Well, I'm going to go back to, oh, that's not what I wanted. Where is my, I'm going to go back to my income tax package page. And you're going to see, remember I said all the really important stuff is at the top. We have the actual return, and then optional, we have the federal worksheet. So that's what I'm going to open now. I'm going to say, give me a federal worksheet. Just going to open a regular PDF. You're going to find on a federal worksheet that there's a bunch of stuff you don't need, and then there's a bunch of stuff you do. So what you're looking for is basically in the same order that it shows up on the return. So the first thing is income-related ones. We're going to come back to this in Chapter 7, but for now, we're going to keep going down until we can find the credits, because we're looking for the basic personal amount, and there it is. So how we do this is we say the base amount is $12,421. The supplement is $1,387. We have to decide how much of that $1,387 they're going to get. The way we do that is we look at how much income they have in that 4th tax bracket, and then they do a calculation that the government has decided is the correct calculation. We're going to take that portion, reduce the personal amount, and whatever is left over, we get to add, and that will give them their new basic personal amount credit. Okay. So what you have to do if they're in the 4th tax bracket is open up your federal worksheet, find this line, fill in the chart, get the answer, and then take this number and put it back on your tax return. And again, I really, really recommend doing your tax returns in order. So as you go down, you do all of your income things first. If an income thing triggers a credit, go deal with the credit. If it triggers a schedule, go fill out the schedule, put all the numbers back on the tax return, start on that line again, and keep going down. It's a really good way of not missing anything when you have to do them by hand. Okay, how do you get the basic personal amount? Everybody gets it. If you're a resident in Canada for the whole year, you get the basic personal amount. You don't have to have any income. You get the basic personal amount. In this class, that's all we're going to do. We're not going to deal with part-year residents. We're not going to deal with non-residents. So for this course, every tax return you prepare, you need to fill out the basic personal amount number. Okay. I would have just said all first-year residents can claim the full amount in previous years because that's what the rule was. Now it's they can claim the full amount unless they're in the top 2 tax brackets, and then they claim a little bit less. But everybody gets a basic personal credit on their tax return. Okay, good. If I only have a teeny, teeny, tiny bit of income, and I'm under the age where I'm eligible for claiming government benefits, would I need to file a tax return? So people say yes. It's kind of a trick question. I like to ask trick questions. The answer is maybe. So remember, going back to Chapter 1, when do you need to file a tax return? If you owe tax, you need to file a tax return. If I have a very small amount of income, knowing that I get a basic personal amount, am I going to owe tax? No. Okay. So the quick answer is probably I don't need to file a tax return, but I'm not finished because I have to go back to that chapter and I have to say, is there any other reason for me to file a tax return? The next question we usually ask is, are you going to get a refund? And the answer is maybe. If that income had tax deducted from it, I might want to file a tax return to get that income back. If that income had no tax deducted from it and I'm not getting a refund, I might not want to file a tax return. Am I going to get government benefits? I already said no, so that's not a good reason to file a return. File a return if you're not going to get anything for it. Does anyone remember some of the other circumstances where even if I don't owe anything and I don't get anything, I still have to file a tax return? If I have a home buyer plan, yep, then I have to. Child tax is a government benefit. If I have a child, if I want to get Canada Child Benefit, then I want to, but they're not getting Canada Child Benefit. If I've been asked to, I have to file, even if I have no other good reason to. If I sold property, that's the one most people forget. If I owned assets and I sold them, have to file a tax return. So anytime someone asks you, should I file a tax return, or does this person want to file a tax return, think about, are they going to owe tax? If they're not going to owe tax, are they going to get a refund? Are they going to get benefits? Did they sell property? Go back to that chapter all the time, because that's going to help you decide. I'm also hoping that you all get the idea that as we do tax returns, you should be thinking about what everything means before you put it on a return. So what do I mean by that? When I see income that has tax deducted off of it, like regular employment income, I'm expecting their employer to have calculated all the credits and tax properly, so I'm expecting them to have pretty much no refund and nothing owing. But if I see tips, I'm thinking, oh, there's income going in and there's no deductions or credits coming off of that. Now I'm thinking they're going to owe. If I see a volunteer firefighter amount, I go, oh, great, $3,000 credit, decent amount of income, they can probably use a credit. Now I'm thinking I'm going to see a refund. So you want to be anticipating the answer before you get to the answer, so that when you do get the answer, you can make sure that it makes sense. So I'm going to keep emphasizing that. And Helene, if they had lots of EI income, they will owe. Yes, we will talk about that when we get to that source of income. EI, when you collect government benefits from employment insurance, they do take some tax off. They never take enough. They take very little tax off. So almost everyone on EI, they owe. And then Leon, excellent question. Just to double check, the actual amount of the credit is 15%. So if the credit is $13,808, the value of that credit is going to be 15% of it. Perfect. Good. I'm thinking that might be a really good place for our first break. So it is 9:47. Let's come back in 10 minutes. So we're going to come back just before 10 o'clock. We're going to come back at 9:58. Okay. Okay, welcome back from break. Give me a green check mark if you are back. Give me a red X if you wish you weren't back, just so that I know that you're here. All right. Like I said, today is not going to be all that intense, but I am going to push a little bit on a few of the next issues, because I think what happens in the textbook is very clear, and then the real world scenarios can get a little bit complicated. So I'm going to add some of that complicated in today, and then we're going to talk through it together, because that's, I think, the most value you get out of me as an instructor is I think I understand this, and then you get into an office and someone sits down and they come up with something you haven't thought of. So I'm going to show you the things that show up in an office every now and again, and we'll see if we can apply what you've read to those cases and really organize it and get the right answer together. So we're going to start with one of my all-time favorite tax credits, which is the home buyer's amount. Okay, it is available to a first-time home buyer. We're going to talk about the definition of a first-time home buyer. How much you get is a $5,000 credit. So if you are a first-time home buyer, by the definition that we're going to talk about, $5,000 credit in the year that you buy the home. So, like all non-refundable credits, if you don't need a tax credit in that year, too bad. I mean, you can put it on the return. It's not going to do anything, and you can't save it for next year. Okay? How much it's worth, like all non-refundable tax credits, is 15%. So if you can use it, if you do owe tax and you need to reduce how much tax you're owing, it can save you $750 by putting it on the return. So one question we need to be asking our clients, and my favorite question to ask, is what's new? What big life changes did you go through last year? Because one of those big life changes might be I bought a house. Okay. How else might we find out that a client that we've seen before has bought a house? What is something that might trigger that question from us? Marisa, absolutely. Brittany, address change. If your client has changed addresses, maybe they were in an apartment and now they have a different address, you can say, oh, you've moved. Where did you move to? And then they usually say, oh, I bought my first house. Great. Now we're having a conversation about something that's going to go on the tax return. And then Helene, RSP income, yes. If they took out a home buyer plan, that's a big clue. We're going to talk about that type of income when we get to RSPs. So there are lots of triggers that can say they might be a first-time home buyer. But if you don't know to ask them that question, you might be throwing $750 of their dollars out the window. So always talk to your clients. Ask them what's new in their life. Find out what they did last year and see if whatever they did is relevant to their tax return. The nice thing about this credit, it can be split between spouses or between unrelated parties. So there are more and more scenarios, especially with younger people, where they can't buy a home by themselves, but they can buy a home with their friends, or they might buy a home with their siblings. They might buy sort of like going in on shares on a property that they couldn't buy on their own. In that case, all of the people who own the property and qualify as a first-time home buyer, so they have to be both sides. They have to own a property that qualifies for the credit, and they have to be a first-time home buyer. Between all of those people, you can split the claim. So here's a question for you. If I have two spouses, they're both first-time home buyers, they both bought their first home together, how can I split the claim? Do I have to split it 50-50 or do I have a choice? I have two possible owners. Okay, and we've got a bunch of people saying you have a choice. You are correct. You can choose. You can say 60-40. You can say 70-30. You can give one person $15 of a credit and the other person the rest of it. You can choose. Why might you not give 50-50? What are some of the considerations you would take in for who you're going to give the credit to? Who needs the credit more? Yeah. So if there's one spouse who has a large income and they owe a lot of tax, then a credit is good for them. The other person might have income that's low enough that the other credits that are before this line number are already reducing their tax down to zero. In that case, I don't want to waste it, right? Remember, we have to do it in order. So let's take another look at our tax return. And here we go. I'm going to jump down to my tax line and take a look at all the credits that show up before we get to home buyer amount. So basic personal amount, there it is. I'm going to skip the rest of the personal credits for now because it's not going to be relevant for this. But remember, all the personal amounts, we're going to see what personal amounts they have first. Then we're going to look, they have CPP, they have EI. Maybe that person is already getting a $3,000 credit because they're a search and rescue volunteer. We've got a Canada employment amount. If all of those credits, in this case up to line 89, are enough to wipe their tax out down to zero, then we don't want to put the home buyer amount on them. Or maybe it's going to wipe it almost down to zero, but not all the way. Then what I would do, if this is beneficial to me, I might see exactly how much do I need to get them all the way to zero, and then give the rest to the other person. You can split it between. Okay, so you have a choice. You cannot go over 5,000. So it is important to make sure, especially if you're splitting it with someone and you're not doing their tax return, that you know how much they're claiming and that they know that they're not going to claim more than that, because you can't claim more than the maximum. If you try to claim more than the maximum, the CRA can take the credit away from everybody. So make sure if you are going to put it between multiple people that you're still limiting yourself to the max. Okay. So how do you get to be a first-time home buyer? Well, you have to have not lived in a home that you or your spouse owned in the last 5 years, okay? Which is tricky. It doesn't mean you haven't bought a home in the last 5 years. You can't live in a home that was owned by you or your spouse in the last 5 years. Okay? That is the rule. If you did, then you are not a first-time home buyer. Even if you didn't own that home, if you lived in it while your spouse owned it, and now you're selling the home that your spouse owns and you're going to move into a home that you both own, you're not a first-time home buyer. Okay? There are a few exceptions to this that will be relevant when we talk about RSP income, but for the credit, we're talking about a credit today, you have to not live in a home that you owned in the last 5 years, and you have to have not lived in a home owned by your spouse in the last 5 years. Okay? As long as that's true, now you're buying a home and you're moving into it, you're a first-time home buyer. And Leon, if you own a home but you rented that home and you lived in a different home for over 5 years, you are classed as a first-time home buyer? Yes, it does get tricky, okay? But if you have not lived in a home that you owned in the last 5 years, that's the question you're asking yourself. If the answer is no, then you're a first-time home buyer. Okay? And Helena, spouse cannot claim? Well, if they aren't a first-time home buyer, then they can't claim the credit. And we're going to test this, so this is going to make sense. You're going to get to practice this. Answer the question for the taxpayer whose return you are doing. Then, if you're going to decide to split the credit, answer the question again for the spouse and see, can I split the credit? But always start with the taxpayer first. Find out if the taxpayer is a first-time home buyer. If they're a first-time home buyer and you think that there's a credit, then, and they have a spouse, then you go look at the spouse and see, from their perspective, do the test again. Does that person, are they living in a home, or in the last 5 years, did they live in a home that they owned? Okay, so this is one of those things where flowcharts, if you're a flowchart person, is wonderful. Because first you do the test for the taxpayer, and then if they qualify as a first-time home buyer, then we have to look at what home did they buy. And then we find out, is there a claim? If there's a claim, the third question is, are we going to split that claim? Then you get to start the test all over again. Okay. The other thing that you absolutely must remember is that this rule does not apply to someone who is disabled. We're going to talk about what disabled means when we get to medical expenses. But for now, we'll tell you disabled or infirm. Okay. If they are disabled and they are acquiring a home that is more accessible or better suited to the needs of themselves or their spouse or disabled relative who's living with them. So now we're looking at a family situation. And if one of the members of your family is disabled, and the reason you're buying a new home is because the home that you're in right now is not accessible and you need an accessible home, then you don't have to worry about whether you owned a previous home. That part of the test doesn't apply. You will qualify for the first-time homebuyer credit anyway. Okay. Can anyone say why we would do that? Why would the government make this exception? What is the goal of the government with regards to whether or not disabled people stay home or have to live in other environments? It is less expensive for the government to have someone living in their own home, especially someone living in their own home with relatives. And so it's expensive to buy an accessible house and move. So they allow them to access these credits on a tax return when they do that. Okay. So there's a kind of cost-benefit analysis. We'll give you the tax credit, and then we're not going to have you in a more expensive for us as a government scenario. Okay. What kinds of things would make a home more accessible? Okay. Ramps or just a place with no stairs. So often we see people moving to bungalows. It might be just a situation of having a suite so that you can move in with a relative. So it might be more accessible, not because of the physical building as much as just because you can get everyone into one house. What about access to medical services? If you have a relative who's living in a rural area and all of a sudden they're going to need a lot of medical treatment, it might count as a more accessible home if you are moving them to a more urban location so that they can access the treatment. So the definition of accessibility is pretty flexible. Okay. The question is, are you moving to this home because of the disability? And remember, not all disabilities have to do with stairs or mobility. You could have a disability that has to do with the layout of the house being important. Perhaps your relative is losing their vision and now they need a home that has an open kitchen. Brittany, renovations to a current home to be accessible. We will talk about that tax credit when we get to the medical expenses. So that one I'm going to say hold on to. When we get to that chapter, there's a different way of dealing with that. So this is just purchasing a home. Okay, so going back to the test, we're looking at the taxpayer first. The taxpayer, did that person live in a home that they owned in the last 5 years? Or live in a home their spouse owned in the last 5 years? If so, they're not a first-time homebuyer, unless there's the whole disability exemption, in which case we can ignore that test and say yes. Okay. The next question we have to do is, did you buy a qualifying home? Okay. A qualifying home must be registered in your name. So it only counts for a first-time homebuyer if you actually end up owning the home or part of the home if you're buying it with someone else. Okay. For it to be qualified for the credit, the home that you are buying must be located in Canada. And it has to be a home that you can live in. So functionally, it has to count as a place that you could legally live, that you could occupy. So for example, if you buy a downtown business property that does not have a kitchen and a bathroom and plumbing, and you're going to use it as a store, but then you're going to live in the storeroom, that's not going to be a qualifying home. On the other hand, if you buy a business property that has an upstairs apartment attached to it, and that apartment is a place you can live in, that would be a qualifying home. So, okay, and Leon, do you have to move in with a certain date? Yes, you do. Can anyone tell me who's read the book when you have to move in by? One year. So this becomes an issue if you have a new build and your builders are very slow, because you are required, if you buy the home, to move into it. And we'll talk about that in more detail when we get to the other side of things, which is when you take money out of the bank to help you get that home through a home buyer plan. So we'll talk more detail about that. But for now, remember that it has to be a home, you have to move into it, has to be in Canada, and it has to be in your name. Okay. Now, as soon as I do this slide, everyone gets confused. So I'm going to go back one slide, and I'm going to ask you, I'm going to try to go back one slide. I'm going to ask you this. Does it matter if the home you lived in the last 5 years was outside Canada or inside Canada? Is that relevant in any way? Can I have lived in a different country, in a home that I owned, and then sell that home, and then come to Canada, and then maybe I'll rent for a year, and then buy a home here and count as a first-time home buyer? Would I get the credit? The question is, did I live in a home that I owned in the last 5 years? Did I live in a home I owned? It doesn't say a home I owned in Canada. It just says a home I owned. So I am not a first-time home buyer. Does that make sense? The test of a first-time home buyer is not restricted to a country. And Helene, I wish I could say that I'm tricky. Unfortunately, I'm not tricky. Life is tricky, and tax law is just really detailed. So the question that I'm asking first is, did I live in a home I owned anywhere? And the answer is yes, but I'm not a first-time home buyer. Okay? Then, after I've asked that question, I'm going to say, can I get the first-time home buyer credit for the house I bought? Now I need to know where the house I bought. I need to know that it's in Canada. If it's in Canada, I can be a first-time home buyer in Canada. So that is always confusing for everyone, which is why I bring it up. And I think we should practice. Okay, so we're going to do our first activity here. This is from the course. So this is what we expect you to comfortably be able to answer after what we've just gone through. Let's see how we do. So Jeff and George are friends. They purchased their first home together in 2021. They both qualify as first-time home buyers. What credit can they claim for the home purchase? I'm going to tell you they bought the home in Canada. And they moved into it. They can claim the first-time home buyer credit. Good, you guys are anticipating me. So we are going to claim the home buyer's amount, which I will refer to as the first-time home buyer's credit. So home buyer's amount, home buyer's credit. I say credit so that I remember that it's a credit on the tax return. On what line amount can they claim it? Someone who has a tax return in front of them, what line number does it go on? Okay, I see a whole bunch of 31270s. I have not memorized this one, but my slide tells me that you are correct, and I would have to look it up on a tax return. So 31270, Part B, Step 5, it is a non-refundable credit, and it comes off right after employment, Canada employment amount. Good. Next question. What is the maximum combined amount they can claim? And how much combined federal tax will they save? So what is the maximum between the two of them? Credit is $5,000. And the amount that they will save is $750 because it's 15% of $5,000. Excellent. Last question, can they split it? Yes, they can. How can they split it? Any way they want to, as long as they don't go over the max. So I can say I like Jeff more than George. I'm going to give Jeff $4,000. I'm going to give George $1,000. I can say Jeff is going to get all of it, and George will get $0. I can say George is going to get $4,999, and I'm going to give Jeff $1 any way I want to, as long as I don't go over $5,000. Okay, if you got that right, you know what you need to know for this course. I'm going to make it a little more challenging because I want to see if you really, really understand the way that we apply these rules. So start with the taxpayer, answer if they're a first-time home buyer or not, then see if they have a qualifying home. Then, if there's someone they're going to split it with, find out if that person is a first-time home buyer. If you do that in that order every time, you will get the next ones correct. So let's try this together, and we're going to do some annotating now. So I'm going to pull your annotation tools up. Okay. Mark and Herman met in 2019 while Mark was on an exchange program in Germany. Herman owned a home in Germany, and Mark lived in student housing. When Mark returned to Canada in 2020, they continued a long-distance relationship. In 2020, Herman was able to sell his home in Germany and immigrate to Canada on a marriage visa. They married in Canada in July of 2020. They rented a home until September of 2021, and then they purchased a home in Brandon and moved into it. Who, if anyone, can claim the home buyer amount? So let me know, can they both claim it? Can no one claim it? Or can Mark claim it? Okay, so start with Mark. Is Mark a first-time home buyer under the rule? Did he live in a home that he or his spouse owned in the last 5 years? If he's not a first-time home buyer, did he buy a qualifying home? And then if the answer is yes, he can claim it. If it's no, then it's going to be no for both because of the way that I set up the question. But if it's yes, then you have to see, can Herman claim it? Okay, so I have a mix here. I've got some neithers and some only marks. So I'm going to do those. Did Mark live in a home that he owned? No, he's never owned a home before. So that's easy. This is his first home, and it's in Canada. I am going to be careful with the did he live in a home his spouse owned. In Germany, Herman owned a home, but Mark lived in student housing. And they weren't spouses at the time. When they were spouses, they rented. They lived in a rental property. So Mark did not live in a home that he owned, and he did not live in a home that his spouse owned. So he is a first-time home buyer. So I know Mark can get it. Then I'm going to say, is it an eligible home? It's in Brandon. They bought it in 2021. They moved into it. So yes, qualified home. So Mark can get it. And then I'm going to look at Herman, and I'm going to say, Herman owned a home that he lived in the last 5 years. He can't get it. And if you got all of those things right, give yourself a pat on the back because this was a difficult one. It was difficult, but it happens in real life. So I borrow a lot of my examples from clients that I've had. Okay, let's try one more. Remember that I'm a sneaky person. So there will be information in here. Take it slow, ask the questions, see what you get. So Beth Ann and Maria, who are married, own a lovely home together in Transcona. Unfortunately, Maria's mother has developed Parkinson's disease and is no longer able to live independently in her own home. Beth Ann and Maria decide to sell their home and purchase a new one. Sorry, that should say February of 2021. So I will correct that. February of 2021, they buy a lovely bungalow. To annotate all. There we go, 2021. They buy a lovely bungalow and Maria's mother moves in with them in May. Who, if anyone, can claim the home buyer amount? When I say both, I mean Beth Ann and Maria. Beth Ann and Maria, can they both claim it and split it between them if they want to? Can no one claim it? Or can Maria's mom claim it? So ask yourself, start with Beth Ann and Maria, then go to the qualified home. Let's see if you want to split it between anyone. I love this one because I got a whole variety of answers. So Beth Ann and Maria, did they own a home that they lived in the last 5 years? Yes. What is the exception that would make them first-time homebuyers again? What is the exception to the rule? If the reason they're buying the home is for themselves or a relative with a disability who's living with them, then the 5-year rule does not apply. Do they have a disabled relative living with them? Yes. Are they buying the home because it's more accessible? Yes. So the 5-year rule does not apply. They have bought a home. They are first-time home buyers. Is it a qualified home? It's in Winnipeg. So can Beth Ann and Maria claim it? Yes. And they can split it between them any way they want to because they are the owners. Okay. In the chat window, if anyone wants to volunteer, or on screen if you prefer on screen, why can Maria's mom not claim the credit? Why can we not split it with Maria's mom, and why can Maria's mom not claim the credit? Because she is not a home buyer. Excellent. Good. So like I said, these tests are very fussy because the rule is the rule is the rule. And you have to stick with the wording of the rule. But if you do that, if you're very, very careful and you think of it in order, you'll get the right answer every time. In real life, if you got this case in front of you go get a senior associate who can help you sort this out, or call on your colleagues and talk about it until you, because we do this all the time, and I'm sure Nancy will agree with me. Something comes up and we go, I don't know what to do with this. What do you think? We sit down and we discuss it together until we can really, really apply the test. Go back to your textbook. Okay. So Helene, what was the right answer for the previous activity? The previous answer was only Mark was the right answer. And this one, the correct answer is they can both, or they can split it in either. Okay, so you're all going to forget the disability exemption. That's why I gave you an example with it in it. Okay. Most of the time, this is easy. Your client rented their whole lives and they bought their first home. You might get into a stickier situation. If you do, go back to the wording of the test. So did they own a home that they lived in the last 5 years? Did they live in a home that their spouse owned in the last 5 years? And then check the exemption. Good. I told you I was going to make it harder. I did make it harder. Remember, the very, very first activity you did is what we're going to test you on in this class. Okay, how would you like an easier one? Here's an easier credit. Digital news subscription expenses. This is fairly new. Some of my clients know about it because the digital news companies are sending them mailing information around tax time going, hey, thank you for paying us money. Put this on your tax return. So my clients have been coming in and bringing me letters from various media organizations saying, this says tax on it, what do I do with this? A lot of other people don't read those and they throw them out. So one question that we can be asking our clients now is, are you paying a subscription to a Canadian news organization for online news? So there has to be a digital component and it has to be a qualified Canadian journalism organization. If that is true, this is a non-refundable tax credit. Right now, it's for 2020 until 2024. Whether or not it continues past 2024 will be determined by the government. What they're doing is they're trying to encourage behavior in Canadians. They want Canadians to be paying for Canadian sources of media. And so if you do that, you get a tax credit, and they're going to see if offering a tax credit makes more people do this. If it's working and people are buying this and using the tax credit, then they will keep the tax credit. If it's not working, it'll probably disappear. We saw this happen with public transit credits. There used to be, and if you go back enough years, I believe it was phased out in 2016, but don't quote me on that, but there used to be a credit for public transit. If you used public transit and you brought your receipts in, you could claim a credit on your tax return. 2017, Nancy says. There were a lot of changes in that year. Okay, but what they found was the people using the buses and subways and streetcars and whatever transit you had were already using it anyway, and everybody who had a car kept using their car, so it wasn't doing what they were trying to do, so they got rid of that credit. How much is the credit? It's a max of $500 per year. It is non-refundable, so if you buy it and you didn't need the credit, then you don't get to carry it forward to a future year. It's just gone. You put it on line 31350. The only tricky part is it has to be a subscription made to a qualified Canadian journalism organization. So how do we know if it counts? You have to look it up. So how do you look it up? Can anyone guess where on the internet I would go to find this information? CRA. So I'm actually going to open a new CRA window here, and I'm just going to say CRA Qualified Journalism Organization. Google will point me in the right direction. Make sure you're working from the CRA sources, and you can also do this just by searching in the CRA box, and you're going to find a list of qualifying digital news subscriptions. There is probably a link in Inkling, and that link is probably working, but when we make the textbook we use the links that we're given, and then of course the CRA likes to change them midway through the year. So make sure you can always look these up. And then what you're going to find is a whole list of newspaper organizations, and then what provinces they are and when they started qualifying. So a lot of them started qualifying in 2020 and continued. And you can see right now there are 166 possible answers. The only one you have to be tricky with, you have to be a little bit careful with, is it does not count if they are only paying for a print subscription. So if you have someone who is physically getting the paper from one of these organizations, and it might be Globe and Mail, or I don't know, name a newspaper that you usually use. If you're getting a print copy, then it's probably not going to count unless there's also a digital portion. If it's mixed digital and print, the receipt will say the digital portion on it, and that's what you can claim. And if it's a digital subscription only, and it's on the list, that will qualify. Okay. Basically, you're going to get a receipt. So ask your clients, do you subscribe to any Canadian news sources? If they say yes, you're going to say, great, which one? Look it up. And then if the answer is yes, tell them to go get a receipt because you can give them a tax credit. For a $500 tax credit, what is the value of that on your return, assuming that they get the maximum? So if they have a receipt for $500, what is the actual benefit to them? 75 bucks. So if you ask, and that's what they're paying per year, that's what you get. Good. If it's a family subscription and they share the subscription, what options do you have with the credit? More than one person is paying for the subscription for the whole family. Okay. You can split it as long as you don't go over the maximum. I probably wouldn't split it because there will be at least one person who can use it, and it's a lot of work to split it when each person is going to benefit by less than 75 bucks. So I would pick who gets it the most, who needs it the most, and then just have one person claim all. But you do have a choice. You can split it if you want to split it, as long as you don't go over the max. Every now and again, you're going to meet a family that keeps everything separate. So there will occasionally be a family that will say, I don't care, we share it, I want half on mine and half on my spouse's. That's just the thing. And if that's what they want, that's what we do. Okay? So as long as you don't go over the max is $500 per digital, well, per family really, per digital subscription. So if they each buy their own because one person likes the sun and one person likes the star, then they each get their own because they're paying for their own. But if they both shared the same subscription, then it's max 500 per subscription, and each taxpayer max 500. Okay. Any questions about this one? It's pretty easy as long as you ask. Ask if they have it. If they have it, look it up, get a receipt. Okay, and let's talk very briefly about refundable tax credits. Up until now, you've learned about 3: CPP overpayment, EI overpayment, and eligible educator school supply tax credit, which we reviewed when we did our self-test. Does anyone remember how many years back can you claim a CPP overpayment? If you're filing an old return, how many years back can you go to get that credit? Okay, this one's a little bit tricky, but we did mention it in class. 10 years to get a tax refund, but only 4 years if your refund is coming from CPP overpayment. So CPP is limited normally. So everyone who said 10, you are thinking correctly. Tax refunds, we can go back 10. But CPP overpayments specifically were limited to 4. Good. What about EI? That one has a weird limitation too. Does anyone know what the EI limitation is? seeing a mix of numbers. It's 3. So CPP, you can go back 4 years for an overpayment. After that, they're not going to give you the overpayment, so you shouldn't put an overpayment on the line. EI, you can only go back 3 for an overpayment. Okay. All other tax refunds, 10. Eligible educator school supply tax credit as long as the credit has existed. So that one's fun because you have to look up each year to see was it on the tax return, and if it was on the tax return and you have receipts and you can get a letter from the employer, then yes. Okay, we will be doing next class provincial refundable tax credits as well, and I will tell you how to claim them and where they go. So you're going to do an MB 479 is the name of the form, and it goes on 47900 of the tax return. And we'll look at that in more detail in Chapter 5. All right, and then we have to talk about climate action incentive. So climate action incentive is a slide that everyone in the country, except for 4 provinces, are going to pretty much skip. We are one of the provinces that we are not going to skip this, and we're going to talk about what it is. So climate action incentive is a refundable tax credit. The tricky thing for this is in the first couple of years that it was eligible, that it existed, and Manitoba's had it since the beginning. So what you'll find is if you're doing older years in different provinces, you have to look to see if that province had a credit that year or didn't have a credit that year because it changes. But Manitoba, since it came into play, has always had it. Okay. It used to be a refundable credit on the tax return. So every previous year, there was a line number on the tax return where you would enter as a refundable credit the climate action incentive for that year, and every province had its own amount. Okay. And then last year, this is the first year, they took it off the tax return. So now, instead of claiming it on the tax return and getting the money for your climate action incentive as part of your tax refund, now they're paying it in 4 payments in the same way that they do the GST as a separate benefit. Okay? It is 1 claim per family. Family in this case means parents and minor children, children under 18 who do not have their own children. So children who are under 18 who are parents will have a separate unit. We'll talk about that more when we get to family situations. But generally speaking, parents and kids, 1 claim per family. And then there is a supplement for residents of small and rural communities. And we have to know who is in a small and a rural community. The easy answer in Manitoba, Manitoba is a wonderful one for this compared to some of the other ones that have very long lists. In Manitoba, if you're in Winnipeg, in the census metropolitan area of Winnipeg, you get the base. Otherwise, you get an extra 10%. Okay? We do have to look this up. For some people who are kind of right on the edges or the outskirts, you need to know where the boundaries are. So you can do that. And Brittany says, do you live in Winnipeg if not you're rural? Basically, that's the test. So most of the time, it's a very easy answer. Winnipeg, you don't get it. Not Winnipeg, you do get it. It does get a little trickier with some of those communities right on the border where it's like, is that technically Winnipeg or not Winnipeg? And those are the ones we have to look up. How do we look that up? Well, you can look it up on the CRA website again, and I'm going to find my CRA. Let's try looking it up this way. So if we're going to say census rural areas. Okay, and if you reside outside a census metropolitan area, and that's what I'm trying to find. Don't need the Schedule 14. Find out if you qualify. So when you search for things, keep looking and you will find it. And then you'll see Alberta, it has a list. Saskatchewan, it has a list. Manitoba, the municipalities that are in Manitoba are listed here. If you're in this municipality, the answer will be yes. If you're out of that municipality, you get the extra, the small and rural community. And if you really need to dial down, because I definitely had at least one client who was like across the street from where they could get it, and they were just a block or two away from where they could get it, there is a map. So you can pull up the map. It takes forever to load. And then you just scroll in. If you're in the purple, not rural. Everybody else, rural. So you can actually go right in and find the street if you need to find the street. Okay. Does anyone know how much you get? This is trickier because we used to have it on the form. We no longer have it on the form. It's not there anymore. So for previous years, it's been different amounts. Last year it was $416, I believe, for the base amount, and then you get extra ones for family members and all of those things. We used to calculate this because it was part of the form. We no longer calculate this for our clients, but we can give them an estimate. And in the new budget, you'll see what that estimate's going to be. But we do have to fill out a Schedule 14 if they're in a rural community. So if you're in Manitoba and you're in a rural community, you need to complete a Schedule 14, which currently looks like this. And all you're going to do is you're going to download the form and you're going to tick the box. You do not need the form if they're not in a rural community. If they're in a rural community, don't forget to do the Schedule 14 because that's potentially a lot of money because it's 10% extra, and then that's per family member really as well. Okay. For now, this is going to keep going up as long as the climate action rules between the federal government and our current provincial government continue to be in effect. If there's a big legislative change dealing with climate in Manitoba, this could go away because the federal government could say Manitoba is now handling climate-related things the way we want them to, so we're not going to do this anymore. Or it could get higher. The idea behind this is the federal government is putting pressure on the provinces, financial pressure on the provinces, to start meeting climate targets by taxing things, and they don't want to pass that cost on to the individual person. They want to keep the pressure on the companies and on the government and not on the individual people. So they are giving us extra money to compensate us for the fact that life has gotten more expensive because of these policies. That's what this is for. Okay. How do you get it? Well, you have to have been resident for the whole year, and you have to be in Manitoba. If you move out of Manitoba, you have to notify the government that you have moved out of Manitoba because you will no longer be eligible for it if you're not living in Manitoba. If you've moved to one of the other provinces that's eligible for it, you will become eligible for that province ongoing. Okay? And you also have to notify them if your family situation has changed. So if you, for whatever reason, no longer have a child that you had before, or you don't have a spouse that you had before, or you have a new spouse or a new child that they don't already know about, you need to let them know so they can adjust for you. And again, we used to calculate this for our clients, and we used to be responsible for calculating it for our clients. We no longer do that because it is being done through the government, and we don't have control over it. How do you get the climate action incentive? What do you have to do to get the climate action incentive other than live in Manitoba? File your taxes. If you don't file a return, you don't get it. Because it's a family credit, who will get it? Because remember, if there are two spouses, only one of them can. Marisa, you are correct. The first person that the CRA assesses is likely to be the person who gets it. We don't have control over that. Can we guarantee whose tax return out of two is going to be assessed first? No. We can try. I mean, you can file one before the other, but that doesn't guarantee that that's the order they're going to get processed in by the CRA. So when you have a married couple and you're doing returns for them, let them know one of you is going to start getting checks 4 times a year for climate action incentive. And it is for both of you to share. Good. Any questions about all of the stuff we just did? Oh, yep. So Leon, if the client owns 2 homes, 1 rural, they live in for 6 months, but they maintain residence in the city, can they claim? So as long as you're definitely in the province, so if both of those homes are in Manitoba, then yeah, pretty much you're going to pick which your main residence is. And in that case, go ahead and file your Schedule 14. Okay. It's trickier because if you own 2 homes in different provinces, we have a different question, which is what province are you resident in for tax purposes? And there will be an answer to that, and we know the answer from Chapter 1. And Helene, does your CRA account tell you if you're getting climate action incentive payments? Yes, it should. I haven't seen it yet because it's new. So I haven't had an opportunity since they made the first payment under the new system to see what it's going to look like. But you should be able to receive that information from my account. You will definitely get mail. So I can tell you, because I personally got climate action incentive, or my husband and I got it, I can tell you that we still do paper mail for the CRA because I have a lot of things to track. We got a piece of mail that said you got your climate action incentive for this month, and this is what it is, and this is what you're getting for the next payments. All right, Bo, if they went out of vacation of the country, it doesn't matter as long as they're resident in Manitoba at the end of the year. So tax residency at the end of the year determines your provincial tax, Chapter 1. Okay. To get the climate action incentive, you have to be a resident in Manitoba or Alberta, Saskatchewan, Ontario, but they get different amounts than we get. And then whether you get rural or you don't get rural depends on where your residence is in the province. Karine, if a child over 19, can the child claim climate action incentive? So if a child's over 19, the parents cannot claim for that child. They don't have an option. They only claim for minor children. So if that child wants to get climate action incentive, what do they have to do? They have to file a return. Yes. So that is one reason why young people should probably file returns, because not only will they get GST benefits if they are low income or have, qualify for GST, which we're going to talk about. Also, they will get climate action incentive if they file. Okay, and then, Brittany says gas alone has gotten way more expensive than the climate action incentive reimburses. There's many reasons for that. It's not entirely climate policies. It's also, war in Ukraine and all kinds of other things happening, supply chain issues. Gas companies enjoy when they make profits and usually don't pass savings on to people. So yes, it is expensive. But certainly the idea being that the bulk of the pressure at this point is on the companies and on the provincial government to come up with policies that are good for us as a whole, and we are being reimbursed for some of that. And the amount we're being reimbursed is going to go up every year as the carbon tax credits go up every year. I will say, in a practical sense, get used to saying climate action incentive. We should be using the correct terminology, and we should be educating our clients to use the correct terminology. However, everyone outside of this course calls this the carbon tax. They go, is it the carbon tax? Did I get my carbon tax? Okay. When they say carbon tax, it's not a tax. It's a refundable credit, which is being treated as a benefit just to make it even more confusing. That's their new thing. They might change the wording of it in a year or two. We call it climate action incentive. You will see me later on in the course. I just abbreviate it CAI, climate action incentive. Excellent. Good. We're going to take another 10-minute break. I'm being really nice today. 2 10-minute breaks. We're going to come back right at 11 o'clock, and we're going to jump into the last benefits. We have GST, Canada Child Benefit, and then we're going to do the review problem, and then we're done. Okay, welcome back. Can you give me an emoticon? Let me know how you're doing and that you are back. I will do the same. I had a sleepy emoticon before, but I will say I'm pretty happy with how we're doing right now. You guys have kept me awake with your useful and interesting questions, keeping me on my toes today. Okay, I do want to see a few more people coming back. There we go. I have on my screen right now, and I will put this up again at the end of class as well. For next class, we are doing all of the federal stuff to the end of the return so that we can get a refund or balance owing. But in order to do that, we also have to do some provincial forms, provincial credits. Most of the time, any other province if we lived in would not be that stressful. But I will say Manitoba has a lot in our provincial supplement. So to make this easier for you, you are not going to be responsible for 100% of the material in your provincial supplement by next class. That would be crazy. That would be expecting too much. What I have done to make it easier, and I will include this, Nancy will email you this list as well so you have it for your own reference. These are the sections of the provincial supplement that I want you to have read before next class. So read the section on Manitoba tax rates. When you read the non-refundable credits, I want you to match with the non-refundable credits that you've learned federally. So there will be a personal amount, a sort of basic personal amount. Make sure you know that one. Look for the other ones that you know, and you're going to notice at the bottom of that page there's a note as well that says these are federal credits that we don't have on the provincial form. So take a note of what you're expecting to see that mirrors what we've done, and make a note of what is on the federal return that is missing, that you already have learned about. Again, we're going to come back to this supplement throughout the course as I add complexity. I will start giving you both federal and provincial rules. Okay? Make sure you've looked at the section on volunteer firefighter and search and rescue. There are some special provincial rules about that. Read those. Manitoba Family Tax Benefit is another really long section. We're not going to do the whole thing. I want you to start with the base amount only, the portion dealing with a single taxpayer with no children. As we get to families, I'm going to come back to it and we'll talk about the more complicated situations. But there is a Manitoba Family Tax Benefit, and you will have to calculate it for your Chapter 5 and all later tax returns. So every tax return you do from Chapter 5 to the end of the course, you will now be doing provincial forms. Okay? And then personal tax credit, only the personal tax credit. Assume a single taxpayer, no children, and skip the part about education property tax credit and school tax credits for homeowners. We will do that later. We're going to bring that in when we talk about seniors. There's a teaching expense tax credit, new for 2021. If you took this course before, you've never seen this because it's brand new, so go read that. And then climate action incentive, and that's it. Okay, so there's a lot of extra supplemental reading, but it isn't going to be the whole book. You can find it in Inkling, Manitoba Provincial Supplement. Make sure, if you've taken this course before, make sure you're in the current tax year 2022. Okay, I will take this away, and we will go back into benefits. So what we're going to talk about for the rest of this class are things that are not on the tax return, but you have to do a tax return to get them. And this is where we need to know your net income figure and your family's net income figures if you have family members. When I say family for this, I'm talking about a spouse. So family net income will be you and your spouse. Okay? We're going to start with a GST HST credit. This is a benefit that you get if you are low income and you live in Canada for the whole year. To get it, you have to be resident in Canada. And at the beginning of the month in which you get the payment, you have to be 19 or older, or be someone who has or previously had a spouse or common law partner, or be a parent or previously have been a parent who lives with your own child. We're going to talk about spouse and child in a later chapter, okay? But it is important to remember that your minor children will be included in your GST benefit unless they are parents themselves or they are married. So minors can be common law and they can be married. We'll talk about those scenarios. But generally speaking, if you have a minor child in your home and they are not a parent, you will get GST for yourself and for them. Once they turn 19, they get their own GST. Okay? And again, to get a GST credit, what do you have to do? If you want the money, file a return. Okay? The GST credit is based on your previous tax return. And so it's important to know at what age you should file your first tax return in order to get the benefit. You can calculate this yourself, but of course, it also requires you to know when the payments are for GST. So can anyone tell me, when are the 4 times of year where you would get a GST benefit? When do they make the payments? So they file a return. When is the first payment? July. Good. So your first payment is July, then October, then 2 more months. The next January, and after that, April. So if I did the 2021 tax return, I will have a payment in July 2021, October 2021, January 2022, and April 2022. Then to get the next one, I have to file another tax return. Okay. There is a really, really useful tool in Inkling to help you with this. So I'm going to find my Inkling, which is not there. Where did it go? Ah, here it is. There's my Inkling. I'm going to go to my library. If you have not yet found this book, go look for it and find it. It's a really, really useful book. It's called Facts and Figures, and I'm going to refer to it a couple of times today. So Facts and Figures has useful information and checklists all in one place. And when I open that up in the first section, I'm going to be going down until I can find the section that says Figure 15. Figure 15, when should you file to start collecting GST payments? And so if you are born before April 1st of 1994, then you don't need to file to receive any benefits. If you were born after April 21st, 1994, then the first return you want to file is your 2012 return, which will give you your GST payments July to April 2013, 2014, and so on and so on and so on. So the idea being, find the year of birth of your client and then go to this chart and say which tax return is the first one that that person should file to get GST benefits if they qualify for them. Okay. It is important to remember these birth dates are assuming that you're not a parent of a child. You could have someone who was born in a later year and they are under 19, but they are a parent of a child. So if you are a parent of a child and that child is living with you, you should file your return anyway because you will be eligible for GST. But this is assuming that it's age only. Okay. Any questions about how to use this chart? I find this one so useful that I printed at the beginning of the tax year and put it on my desk until I know which years I'm kind of talking about for that year, so that that thing that we looked at for CPP proration, the same thing. I need to know which year is the relevant year for birth dates that have to do with GST, so I can make sure I'm giving the best advice to my younger clients about when they should be filing returns if they're not getting a refund on that return. Okay. Going back to my slides. So that's who's eligible, and you have to be resident in Canada to get GST. If you leave Canada, you need to tell the CRA you've left Canada because they're going to stop paying you GST. Okay. Who gets it? Well, if you filed it, it's based on the previous year. In the case of couples, it's paid to whoever's return is assessed first. So same idea as it was with the climate action incentive. The order of the returns being processed is going to determine who gets the payment. Okay, how do you calculate it? We don't calculate it for our clients. That's the first thing I'm going to say. I will teach you how it works. You will be asked questions about how it works. But generally speaking, we're not going to be having you practice this because we don't have any control over it. So the only thing we have control over is the net income figure. And once we have a net income figure, it is up to the government to do the calculations. Okay. We do need to make sure the government is aware of their tax family situation. If they have a partner, if they have children, we can help make sure the government is aware of those things, but we don't calculate the credit ourselves. Okay. We do estimate it for our clients just as a service that we give at H&R Block. So we will tell our clients, you can expect to be getting this much. But even the estimates we don't guarantee, which is very good because some of you will remember when COVID happened, there was an extra GST payment in that year. And there were a few people who didn't qualify for GST but were right on the border, and they increased the eligibility for GST for that year as well because of COVID. And so the estimates that we would have given based on the information we had at the time would not have been correct because the government changed its mind mid-year. So we give estimates. Okay. How you calculate it, the base credit is 306. Then you add on a credit if you have a spouse or common law partner. You add a credit for an eligible dependent. You don't know what that is yet. I will be teaching that later. So for now, that will not be something I'm going to ask you about. But when we do eligible dependents, I'm going to remind you of this calculation and how it works. And then every eligible child, so any child that isn't an eligible dependent, is $161 per child. And there is an additional credit. Now, the additional credit I find most people get very confused about. So I want to clarify that for you. The additional credit exists for single taxpayers. So if you are not married and not common law, then you need to think about the additional credit. Okay? So rule number one, basic credit, everybody. If there's a spouse or common law partner, add the spouse amount. If there are kids, add the kids. I will be teaching you that later. If there is no spouse or common law partner, put the additional credit on, and then to find out how much of the additional credit we need to ask, is that person a single parent? Single parents who are not married and don't have a common law partner get 161 additional, flat out, no reduction. So if you have a single parent, they will get the basic credit. They will get an amount for a child. We'll talk about which amount for a child they get later. That depends. I will teach that to you when we get to more complicated family situations. And they will get 161 additional credit. Okay. If they are not married and they don't have a common law partner and they don't have a child, then they get the additional credit, but you have to reduce that credit by an amount. Okay, and that's based on the threshold, and that changes. So there will be a supplemental threshold. You're going to find out how much income they had over that threshold. You're going to take 2% of that, and you're going to reduce the $161 by that figure until it's zero. And if it's zero, then they don't get the additional credit. Okay, so I know that's complicated, but that's how that works. Okay. Then you get the actual GST credit and add them all together. Now we have to find out how much of that you get. As your income goes up, you get less and less GST credit. So you're going to take your family net income, and then any dollar over $39,826 in 2021, you're going to take 5%, and that's what you're going to subtract from your GST. And so there will be a point after that that you will hit where you get zero GST credit, because your income is now too high. Okay. Again, all of these numbers and thresholds and things like that, they can be really hard to find in the book, and they are not things that we memorize, partly because we don't calculate this, and partly because we don't, because they change every year. So if we memorized it this year, we'd have to redo it next year. Everything like this is indexed to inflation in some manner. So what you can do, again, go back to your facts and figures book, because in your facts and figures book, it will tell you what the amounts are for each year and what the thresholds are. So I'm going back to my facts and figures. Figure 14 you can see that in 2021, it was $38,892 was the net income threshold. So every dollar over that, we have to start reducing the credit by 5%. It tells you the base amount, and it tells you amount for elder dependent, credit for qualified children, single supplement phase-in threshold. So if you are a single person without children, that's going to be reducing your additional credit. Every dollar over $9,686 will reduce by 2%. And single supplement with children is that amount. And so you can see we're using the July 2022 figures because that is what is based on the 2021 tax year. Have I confused everyone? Let me know if you have questions about GST generally speaking. I will say the best way to do this is look at the example in your textbook. There is an example. It is illustration 4-8, and it shows you a calculation for a real scenario. So that's going to be the way to do it. If you have to do it for an assignment or for a review problem, there is no form because we don't calculate it. So we don't have a form for you to help you calculate this. What you have is an example in your book, and you're just going to use that example as a template to do the math. Okay? We will practice this when we get to our review problem today. All right, well, that is GST. Let's talk about the other benefit. The other benefit is the Canada Child Benefit. Everyone is going to call this child tax. Okay? Everyone that I've ever heard calls this, am I getting my child tax? Where's my child tax? There used to be, when I started learning to do taxes, there was not a benefit. There wasn't a refundable credit. There wasn't a government tax-free benefit. There was a tax credit. And the problem with tax credits is you have to have taxable income for tax credits to benefit you. And so when the government changed, they changed the rules. The first thing that they did, instead of a Canada Child tax credit, was the Universal Canada Child Benefit, which was income that you received. And that existed up until 2017. In July of 2017, they changed from UCCB to CCB. UCCB, Universal Canada Child Benefit, was a taxable source of income. So there were rules about how to deal with that. So if you see a tax slip and it says UCCB on it, or it goes on a UCCB line on the tax return, you're going to have to look up the special rules for UCCB income, because there are rules about whose tax return that income has to be reported on and how that's handled. I'll mention it briefly when we get to those lines on the tax return, when we get to family situations, but mostly what I'm going to say is if you're dealing with a tax return that has income from an older year. So the income, you can still get UCCB income, but you're getting it from having children in a prior year and not making the claim in the prior year. If you see one of those tax slips, that's when you're going to want to go to your book and you're going to look up the rules then. It's not something I expect you to keep in your head. Just know that it exists and then go look it up. CCB is our newest one. This is what we have now. This is the system you do need to know about. It is a non-taxable benefit. So it is money that the government gives you, and you don't have to put it anywhere on the tax return. You will still get some clients coming to you going, I want to file my taxes, but I'm not ready. I'm still waiting for my tax slip for the carbon tax, for the child tax. I haven't gotten my tax slip yet. And you have to reassure them they're not going to get one. When it was UCB and it was taxable, they got a slip every year that reported their CCB income, except it was UCCB income. The average taxpayer does not know the difference between those two programs. It's all the same to them. So they're very stressed because they haven't got their tax slip yet. You have to reassure them you don't need that one. It's not going on the tax return. It's not taxable. Come in and file your taxes and we can go from there. I'll explain it to you. Okay. It is paid to low and middle income families with children. In order to get it, both the taxpayer and their spouse must file a return every year. Okay, so taxpayers and spouse. So this is a scenario where you might have no income and you might not have sold any assets, and you might not have a home buyer plan. You may have no reason to file a tax return, except that you have children and your family net income qualifies for CCB. In that case, you must file. If you don't file, you will not get your CCB. Okay. Who gets it? Well, the CRA has to know about your children. If your children are born in Canada, you don't need to do anything. They already know about your children. So once you have a child in Canada and their birth is registered in Canada somewhere, the CRA will have your previous tax returns, they will know about your child, and you will start getting CCB and you don't have to do anything. However, there are some circumstances where the CRA does not know about your children. Either your children came from a different country into this country, or they might have been born in a different country and come here, or you might have acquired children in a different manner. Can anyone tell me, how do you acquire children? What are circumstances where you might need to think about doing this? So if you haven't registered your child anywhere with the government, yeah. So if you don't have a birth certificate, adoption is a big one. And it doesn't have to be a formal adoption. It can just be a change in custody. So you can have a family scenario, and this happens all over the place, where for whatever reason, even if the parents are still alive, they are no longer looking after their child. That child is now living with someone else, that's being cared for with someone else, even if there's no formal adoption. Okay? In that case, you have a child who you are caring for. We'll talk more about children when we get to the family unit as well. But in that case, you need to tell the government that you have a child. You do that using a form RC66. So if you're interested and you're curious, go ahead to the CRA, look up a form RC66. It will have a whole set of scenarios for when you use that form. We use that form to give information. One thing that's on that form is, I have a child that you don't know about and I should be getting CCB. Please let me know. And the form will tell you what documentation needs to be brought with it. So you'll have to have some proof that they are your child and that they are here, and it tells you on the form what is acceptable proof. Okay. So if you have a client who thinks they're supposed to be getting CCB and you agree based on their family income that you think they should be getting CCB and they're not, this is the form that you want to help them fill out to get those benefits. Okay. The other important thing is we need to make it very, very clear to our clients that if their family situation changes during the year in any way, they need to advise the CRA of that change, with one exception, and that is if you have a child that they know about who turns 18 and no longer qualifies, they already know their birth date. So that you don't have to notify them for separately. They will adjust if your child has aged out of Canada Child Benefit. But other than that, if there's a change in your number of children, your marital status, or your address, you have to notify the CRA if you want to keep getting your CCB. If you don't notify the CRA and something has changed, it can be very expensive for your tax client. So for example, if you have a family, and I had this happen, if you have someone who is a single parent to, let's say 4 children, they're coming in now and it's March and they're going to file their tax return for 2021, and you ask what changed last year, and they say, it was really exciting last year. I got married. Oh, that's wonderful. When did you get married? Oh, I got married in May. Okay, great. Who did you get married to? How much income do they have? Oh, they have a lot of income. They had a lot, like very, very nice income. They did not tell the CRA that they had gotten married in May. So they were eligible for Canada Child Benefit for January, February, March, and April. And then in May, they were not eligible for Canada Child Benefit because their family income was too high. However, they received Canada Child Benefit for May and June and July, all the way until March of this year. And anyone who has received Canada Child Benefit, if you can imagine someone on a very, very low income with very, very young children, that is a lot of money that they had to pay back. So If you have clients receiving Canada Child Benefit, make it very clear that if they have any changes in their circumstances, they need to notify them ahead of time. If you tell them ahead of time, if you say, hey, I got married this month, the CRA will stop giving money to you, and then you will not have to pay them back. It is always better not having to pay them back, because CCB in particular tends to be quite a lot of money, which makes it difficult to pay back as a lump sum. And then you end up with someone with an uncomfortable debt situation that's not much fun for them. Okay. I want to mention something, and this can be a little bit triggering, so I apologize in advance, but can anyone tell me of another time when you might have a change in number of children that you need to notify the government of, the CRA specifically of, in order to avoid a really big problem? And Leon, you've touched on it exactly. It's if one of your children dies. If your children either is no longer in your custody and care, or if they die, you have to tell the CRA that that has happened at the time that it's happened. Because if you don't, and you keep collecting CCB, then you will have to pay all of that back. And it is heartbreaking to have someone come in to file a tax return and tell you about their young child who died, and at the same time, by the way, here's your big bill to the CRA, because you were dealing with the death of your child and you did not think about CCB because it's automatic and it happened. So that is something that we have to be sensitive to. It does happen, and it is something that you have to be prepared for, making sure that if you do know of that situation, that you let them know what's going to happen when the death is registered with the CRA. The problem with this is, even if they've notified other government organizations, the CRA has to be notified separately. And it's just really unfortunate, and it's adding a whole bunch of pain onto an already uncomfortable situation. So that is something that does come up. The other one that you would say is just, again, you may have someone where, for whatever reason, they used to have custody of a child, they no longer have custody of that child. They need to notify the CRA as soon as the child is no longer in their care. And Leon, does the CRA allow for payment plans in those situations? Yes, it does. So we can help in those situations. And we'll talk at the very end of the course. We do have options for something called taxpayer relief, which is for very unusual situations where a taxpayer has a debt that they cannot pay back for reasons that were outside of their control. We may have options under there, but the reality is, in most cases, they do end up having to pay that money back, even if it is difficult for them. Okay. The happier side of things is having clients who have children. They may adopt children. Maybe they had a baby born that year. So again, going back to my favorite question, most of the time when you say, what's new with you, what changed between last year, what big exciting things happened in your life, they're going to go, oh, and we had a baby. Oh, that's wonderful. Congratulations. Let me talk about CCB, what's going to happen, how you get it, what you need to do, and we have our conversation from there. Okay. How do we calculate CCB? Oh, I'm going to go back one. Sorry, we're going to do an activity in a minute. How do we calculate CCB? Well, again, we don't. It is especially complicated when we get into mixed family situations. We're going to talk about this. We get to more complicated things. Custody, split custody areas, all of that stuff. So we do not give final answers to clients. We give estimates, and then we tell them this is an estimate, and the CRA will determine what you actually get. It runs roughly the same way as it does with GST. You get a certain amount per child depending on their age. So there's a larger amount for children who are, I believe, 6 and under, and then a smaller amount for older children per year. And then it is adjusted depending on your income. The adjustments are a little harder to kind of understand, so I'm not going to be asking you at any time to give me a calculation, just to get a general range for how that works. And again, I'm going to bring you to that facts and figures book. So what you will find is a figure 16, child tax benefit amounts. Child tax no longer exists, so it's only old years, and you can see child tax existed until 2015. Then we're going to switch over to Canada Child Benefit. Okay, and you get an amount per child under 6, an amount for child 6 to 17. There's a base amount, and then they start to phase it out. So your first threshold, if you're 32,797 for the previous year, then you will get that per child. Family with one child has a phase out 7%, 13.7, 13.5, 3, and then large families 23. So it depends on how many kids you get, how much is phased out. Then you have a second income threshold. So between 32,797 and 71,060, it starts to reduce how much Canada Child Benefit you get, and that continues until it's reduced down to 0. And it gets extra complicated when you have a disabled child, because there is a second amount per disabled child, and then you get a bump if you have more than one disabled child. And there are different thresholds for that. And then, of course, because the pandemic was complicated, there was a top-up in May of 2020 because of COVID, $300 per child. And then they did supplemental payments in 2021. If your family net income was equal to or less than 120,000, it was $300. And then if it was over 120, but you qualified for CCB, you got $150 per child. Okay. All of this is tax-free. And again, I don't try calculating these. I don't want to know how to calculate them. If your client wants to know what they're going to get, there is a CRA calculator. You can just Google CRA Canada Child Benefit Calculator. They have to know their individual family situation. So they'll need to know how many children they have, the birth dates of their children, if any of their children are disabled, and their net income and their spouse's net income. If you have that information, you can help them with the calculator online. Our tax software will give an estimate, but again, that estimate depends on other issues with their family situation, so it gets more complicated if you have a split custody situation, and we'll talk about that later in the course. Okay. If you need thresholds, facts and figures is the place to go. All right, let's do an activity to see if you know who gets Canada Child Benefit. Jack and Jill are married. They have 2 children. Jill is the recipient of the Canada Child Benefit. Jill is getting the money every year from the government. What does she have to do if she wants to keep getting her Canada Child Benefit? File a tax return every year. As long as her children qualify for it, file a tax return. What does Jack have to do for Jill to keep getting the Canada Child Benefit? My whole chat for this entire page is going to be file. Even if he's not getting the Canada Child Benefit, they are married, they both have to file. That is relatively new. With Canada Child Benefit, that became the rule. So all of a sudden, in 2017, we had a whole bunch of people who never filed a tax return because they didn't need to, because they had no income. They have to file, and you have to file every year. And if you don't file, you don't get it next year. Because the government needs to see your family net income to calculate how much you're going to get. And Elaine, if you separate, we will talk about this in more detail. If you separate, you notify them that you've separated. In that case, you have to file, but how much you get is going to depend on your custody situation. So we'll talk about that in more detail when we get to complicated family situations. Okay, but you're not responsible if you are separated or divorced or widowed for the other person filing a tax return at that point. At that point, you're responsible for yourself. But if you're married or you're common law, both people have to file or nobody gets the CCB. When we ask who gets the CCB, I wish that I could say it's just like GST and climate action incentive, it's whoever files first. But in real life, in a heterosexual couple, who usually gets the money? The government gives it to the female. I don't know if that's going to continue. That has been the practice. So we see 9 times out of 10, the person receiving CCB is the female presenting partner, because there's no good reason for that. It just is what it is. Okay. That might change over time, but that is what it is right now. Part of it is because of custody. Part of it is because it used to be that women in regular marriages had lower income, and UCCB had to be reported by the lower income person, so the receipt was usually in the lower income person's name anyway, and that often was women. But that really hasn't been true for a long time now, and we're even seeing custody. Custody is much less. It goes to the wife automatically and is much more split. It is much more shared. So the legislation has not, it's not even the legislation, the government practice has not really caught up with societal changes. And we'll see 10 years from now if we're saying the same thing. Okay, so what does Jack have to do? File every year. Okay, that's it. So we're going to do the review, and then we're done for today. And I think for this, I'm going to go back to my textbook. So for those of you who are finding it extra fun to flip back and forth between different resources, I very often figure out as I'm going through a course which of the pages in my reference guide I want to refer to frequently, and I just print those ones. Same thing, my facts and figures, there's a few pages in here. I just print them and keep them on my desk when I'm studying. And then I can continue to stay in my regular book. You can have multiple books open at once if you want to. So it is possible to have your facts and figures book open in one window and your fundamentals book open in another window. So if that's comfortable for you, do that. If we have time before we get to the assignment, I will also review how to use split screen and how to tab back and forth so that if you are doing everything online, because it's difficult to print everything, you'll be comfortable when you get to the actual assignment where you have to be in ULearn entering things, flipping back and forth between your books. So we'll do that in a later class. All right, I'm going to go to fundamentals. I'm going to go to chapter 4. I'm going to go down to my review problem, and let's take a look at this one together. We have Charles Masterson. So Charles, going to look at his date of birth, 1966. Nothing is triggering me there to say that I have to worry about proration or other things we've learned. He is divorced. I have an address for him. In my case, your city is Winnipeg. In your province, YP is Manitoba. And I'm going to change the first letter of his postal code to an R, so it makes sense with me. Saskia, the pages which would be best to have on your desks really depends on what you're using. For me, I don't like memorizing thresholds, so if I have to look up a GST threshold or a CCB threshold, I find those ones useful. Those are the figures I showed you today, so you can go back and take a look at which ones we looked at there. I will always mention, as we're in class, this is a useful one. I'm not necessarily going to send you a list because you're going to find which ones you're good looking up and which ones you really need to have a reference guide for, okay? So if you're not sure, take a little bit of time in the next week, go into that facts and figures book and go, is there anything in here that would help me? And it's amazing to me how many people who have taken lots and lots of courses from H&R Block don't even know that that book exists. And they will call me in an office and they'll say, I can't find such and such a number. And then I just magically know the number. And it's not that I magically know the number. I don't memorize any of this stuff. I'm just really good at knowing where to look for it. And Facts and Figures is one of my favorite books. And my Tax Academy reference is my other favorite book because I can get to the information I want in these really handy summary charts so I don't have to go searching through my textbook or through the CRA to find them. All right, so I've got Charles. I've put him in Winnipeg. If you're not in Winnipeg, put him elsewhere, because if you put him elsewhere, you should be filing a Schedule 14 and giving him a little bit extra climate action incentive. So I want you from this point on to practice the returns for the place that you are in. When we are getting to results, if you want to see what that looks like on a tax return, I will show you in mine because I can flip between where I am very easily. Okay, and I have an email. During the last 10 years, he lived in a rental apartment in my city. In May, he purchased his first home in a decade. So he has not lived in a home that he or his spouse owned in the last 5 years. And he moved into it in June. Okay, we'll talk about moving expenses later. We're going to do that next class. Moving expenses are fun. If you have not read Chapter 5, spend some time on Chapter 5. There's a lot in there. Okay? But we aren't going to do moving expenses. We are going to think about giving him a first-time home buyer amount. So I'm going to say it's his first home. And the very next thing I do, as soon as I open my tax return, somewhere in the back of my head, I'm like, I'm going to have to make sure I remember that one. Don't forget it. Is he going to split it with anyone? Nope. Okay, so not splitting it because he bought the house by himself. He's the only owner. Okay, he works as a teacher. He spent $3,000 out of his own pocket for school supplies to help him with his teaching. We need to know what he spent the school supplies on. I'm going to tell you, for the purpose of this, they are all eligible for the credit. So he wants to deduct $3,000. Can he deduct $3,000? No. Only one. I might send him over to my wonderful senior associate and say, hey, can you take a look at this and see if he can claim these things as employment expenses? That person's going to look at the receipts that he has and go, unfortunately, these do not qualify as employment expenses, so we can't do it that way. You're better off doing it just as the refundable credit. Then you're going to come back to your client and you're going to explain to him you're limited to $1,000, but I can put that on your return for you. So I'm going to circle that $3,000, and then I'm going to cross it out and I'm going to write in $1,000. Okay, he wants to register for online mail, so we're going to do that. He wants to answer yes to Elections Canada. He doesn't own foreign property. Here's a T4. He has a pension plan. That makes sense. He's a teacher. I'm expecting to see that. He has union dues. Also makes sense. I'm expecting to see that. Don't have to worry about the box 40, but I am going to notice that his EI insurable earnings are less than his EI income. So I'm probably going to be seeing a possible overpayment of his EI. Regardless, I'm going to be doing a Schedule 8 and a T2204. Okay. Now it says answer the questions below. What are his options regarding the 3,000 teaching supplies? We've already talked about that. He can try to claim it as employment expenses, but in this case, I'm going to tell you, for many, many reasons, he's not going to be eligible there. In that case, we're going to put $1,000 on the return as a refundable credit, and the rest of it, he doesn't get anything for. Is he entitled to any other claims on his tax return? Can anyone tell me what claims he's entitled to? First-time homebuyer, definitely. What else? Think of deductions. Think of credits. Let's see if we can make a list and get all of them. Basic personal amount, yes. What deductions can we give him? Start at the top of the return. Union dues, yes. What else? Circle my cursor over here. Pension plan, RPP deduction. Wonderful. Now let's talk about credits. What credits can he get? CPP and EI credits. What's the one we're going to forget? Non-refundable credit climate action incentive, yes, because we're in Manitoba, but what's the credit we're going to forget? He had income on line 10100, Canada employment amount. Don't forget that one. He's going to get that one too. Good. I think we've probably got everything, but we'll double check when we get to the return. And let's take a look at his return. Okay, so hopefully you're all very comfortable with the first page now. We're going to fill in his name, his address. I'm in Winnipeg, so I'm going to do Winnipeg. And then email address. Because he wants to sign up for online mail, we're going to do that for him. This will be the only year we do it for him because next year he will already be signed up. SIN number, date of birth, he is divorced, English. Province or territory of residence in Manitoba, don't forget that one. We need to make sure they know he's in Manitoba or he's not getting climate action incentive. Don't need spouse because he doesn't have one. We're going to say yes, and we're going to say no to foreign property, and we're going to put his income in, $48,789. He didn't have tips, he didn't have anything else. Generally, we don't tip our teachers, so that's going to be his total income as well. Deductions, I want to see the pension adjustment, which is a reporting figure. It is important. Even though you aren't using it on the return, the government is using that number, and it will change what happens for future returns. So we do need that number reported. Then we have his deduction, which you want to remember to ask for the deduction because it's going to reduce his taxable income. And we have union dues. And the next thing we're going to hit is CPP. So I'm going to stop there, and I'm going to go do a Schedule 8. What number will I put in Box A of Part 2 of Schedule 8? Always fill in Part 2, Box A. So in his case, what number will I put there? I will put 12. So I will not be doing any prorating. We're just doing a straightforward calculation of CPP to find out his base amount and his enhanced amount. If you did it correctly, you should notice that his employer got it almost right. They were very, very close, but he did have an 8-cent overpayment. So we have to be careful and calculate down to 2 decimal places because he is still limited to the maximum for his base contributions and his enhanced contributions. So the base contributions figure that we're going to take is the required, and the enhanced is the required, not the actual, because it was off by a little tiny bit. Okay? So it's a difference of 8 cents, but that 8 cents is something the CRA knows about. So from this, I'm going to take his required CPP, I'm going to take his required enhanced amount, and I'm going to take his refundable 8-cent credit and take that 8 cents and I'm going to put it on line 44800. Okay. And I'm going to go back to my deductions page, and there's my 226.45. If you did your Schedule 8 correctly, it's 226.45. If you didn't do it correctly, that's okay. That's how we learn. Try it again. If you ever get a Schedule 8 and you're like, I'm not sure if this is right and I don't want to keep going, and you have time, send me an email. I'll look at it for you. Add everything together, registered pension plan, union dues, and the enhanced CPP. We get 1936.45. Net income is 46,852.55. Double check your rounding. It's a really nasty way to lose marks on future assignments if you round wrong. So double check your rounding. 2 decimal places for the tax return. Taxable income is the same, 46,852.55. You can now fill in that he is in the first federal tax bracket, so he'll be paying 15% on that. And you can calculate his personal amount. He's going to get the full personal amount because he's in one of the bottom 3 tax brackets. In this case, we do not need the federal worksheet, and we're not going to take the lower personal amount because his income is quite low. So 13,808. I have not taught you the rest of the lines on here, so until I do, don't use them. 13,808 will be his personal credits. Now we're going to get his base CPP. We did the Schedule 8. To do the EI, before we do that, we need a T2204. So bear with me while I flip again to, where did it go? Here it is, my T2204. We're going to enter his box 24, which, be careful, is different than his box 14 in this case because he had some taxable benefits that were not insurable income. Okay. Then we're going to do his total premiums deducted here, subtract, and it's negative, so that's 0. Moving on to find out whether there was an overpayment or underpayment. He's eligible for $759.49. He contributed more than that, and so he's got an overpayment of $11.38. Hopefully everybody got that one. That is going to go where it tells me. It says if it's more than $1, put it on line 45,000. You'll notice there was no restriction on the CPP overpayment, and there is a restriction on the EI overpayment. Don't ask me why, because it's because the government said so. So in this case, 1138 goes back to the bottom line of the return, and I'm going to take the allowable amount of EI, not the actual amount of EI. Take the allowable amount of EI, and I'm going to enter it as a non-refundable credit. I'm going to keep going. He's not a volunteer firefighter. He's not a volunteer search and rescue, so he does not get the credit there. He does have the employment amount, employment amount. We're going to put the max in for him. And we're going to add the home buyer amount. We're not splitting it. We're giving all of it to him. We're going to add all of those credits together. We should get $9,258.30. Then we add the personal credits to that. Then we get $23,066.30. We're going to keep carrying that down because I haven't taught you anything on the rest of that page yet. 15%. We're going to reduce his federal tax almost by half, thanks to the credits. At this point, do you expect that he will owe money this year, or do you think he's going to get a refund? I haven't even talked really about the refundable credits, but what do you think? We would expect for this taxpayer to be getting a refund. Do you think next year, if everything else is the same, is he going to get the same refund, or is he going to get more or less? Is there something that happened this year that's special? He's going to get less because he's a first-time homebuyer. That $5,000 credit is a big difference on his return. So I like to tell my clients, if I'm going to give them a nice refund, I like to tell them, guess what? You're going to get a really nice refund this year. Don't plan on getting the same refund next year. Next year will be different. I will tell you, and I'm sure Nancy will agree with me, every client remembers the best refund they've ever got, and then in their head, that's what they get every year. I will have a client come in and I will say, oh, congratulations, you're getting a refund this year of $400, and they'll go, that's not right, I always get $4,000. And you look at their tax history, and for the last 4 years, they've owed money, and the year before that, they had a nice big refund. And they conveniently forgot that they usually owe money, and now I've given them a refund, but they will remember that 1 year forever. So when you have an unusual thing creating a refund, let them know this year, nice refund. Next year, not so nice refund. Get ready for it, because I will tell you they've already spent that money in their head before they even sit down in your office. Okay, so home buyer amount is making the big difference. I'm going to jump now to the end of the return, because what we haven't dealt with is eligible educator school supply. Hopefully, you've all added in 1,000, because that is the maximum, on line 46800, which is a reporting number, and then 250 is what he's actually getting back. I can tell you in this case, for various reasons, we're not going to look at the actual refund or balance owing because it doesn't really make sense because of other things that I haven't taught you yet. But generally speaking, make sure you know how to fill out these. By the end of Chapter 5, you will know how to do the whole 8 pages of the return to a resolution. Okay? And the last thing I want to do is GST. So for GST, I have a form that I use for estimates. I don't have a copy to give to you. Use the example, the illustration 4-8 in your Inkling in order to get the same numbers that I'm getting. So I'm going to have his net income, which is his family income because he's divorced. He's going to get 306 as his base claim for himself, doesn't have a spouse, doesn't have children. Then we need to do the additional credit. This is the part that you may have forgotten. If he was a parent, we would be adding 161. He's not a parent, so we have to add some amount to a maximum of 161, and the amount depends on the threshold. So we're going to take his adjusted net income, subtract the threshold, which for 2021 is 9919, take that number, multiply 2%, and then we either get 161 or we get 2% of that number, whichever is smaller. And in this case, his income is low enough that he will get all of it. There is a point where his income will be high enough that he won't get the full amount. So it depends. What you get goes up and down. If you're too low income, you get less. Then you hit the point where you get the maximum, and then you hit a point where you start phasing your GST credit out again. Okay. So 306 in his case plus 161. Now we have to know how much of that he actually gets. So this time we're going to take his net income, subtract the threshold for GST, which is 39,826. We look at the income over the base amount, take 5%, and use that to reduce his GST credit. In this case, we reduce his GST credit by 351.33. It gives us 115.67. Okay. You'll get that in 4 payments. Unless, what is the scenario in which you don't get 4 payments of GST, you only get 1 payment? So sometimes, if it's a very small amount, they will not split it into 4 payments. They will just give you 1 check in July. And that's because it costs the government money to print checks and to do direct deposits. And sometimes it's like the GST is so small, you're getting a couple of dollars. In this case, he's getting $28.91. So we will tell your client you can expect to get 4 checks, or if the amount is very small, you can expect to get 1 check of $115 in July. Good. What happens if you didn't file for 3 years, but you were eligible for GST for 3 prior years? When do you get that GST? So this is how you get next year's GST. File a return for this year and you'll get 4 payments. If you have an old amount of GST and you file that return, when do you get your GST? So I have old refunds. I'll get them 10 to 15 business days after the after the tax return is processed. The GST will come in a lump sum on whatever the next GST payment is going to be. So when I file those years, once they are filed, they're going to add up all the missing GST, and they're going to wait until the next scheduled GST payment. And the next scheduled GST payment will be, might be July, might be October, might be January, might be April. Whenever it is the next time that they're going to get it. And they won't have to get it in 4 payments. They'll get it all at once in a lump sum. And Helene says, with interest, nope. If the reason that you didn't get it is because you were late filing, they will not pay you interest on it. If they held on to your return after you filed it for 3 years and didn't process it for whatever reason, and you did file it on time, then they will pay interest. But if you should have filed it and you didn't, they will not pay you interest. You just wait. Okay, good. We are done. We have 1 minute before the end of class. If you have questions, ask questions. Otherwise, all I'm going to say is have a really good day. Make sure you have read Chapter 5, but more importantly, make sure you have looked at your provincial supplement. Manitoba is difficult. Make sure you're looking at those. Okay.